Well, thank you so much for having me, Tracy. My name is Kristen Bonnier. I'm a mortgage broker. I live in the Tampa Bay area. I have been doing mortgages for about 10 years. I have a husband and a son, and as a wife and a mom, I really love what Savvy Ladies is doing. I think that oftentimes women are left out of the financial conversation. I work with a lot of women who are getting divorced or their husband has passed and they have no idea about their finances. So thank you so much, Tracy and Judy, for everything you do within this organization. I really feel honored to be here today. Last week, we had our first session on leveraging the equity in your home, excuse me, and we really spoke about how to tap into that equity. So whether that be a cash out refinance or a home equity line of credit, being the two avenues to really get that equity, get the funds out of your home. Today, we're going to talk about what you can do with those funds and really leveraging that money. So with that, I'm going to turn it over to Ashesh.
Thank you, Kristen. Hey, welcome back, everyone. Those who were able to join us, we really appreciate you are coming back and joining us today. And those who are new to today's session, welcome. I ditto what Kristen said. Savvy Ladies has an amazing role that they are playing and actually connecting the people with financial understanding and need with the professional. And I think that's one of the best things that they are doing. Um, I am so much privileged to be here and actually part of this conversation. So, before we kind of jump or dive into today's session, I really wanted to uh, 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 recap whatever we did last time, and just so we are on the same page. I know human brain plays a lot of tricks. We don't remember everything that we did one time, so kind of I have to reread everything twice in order for me to understand and get it. So let's get started. So home equity line of credit that we spoke last week is nothing but actually leveraging equity within your home's value. So what happens is majority of the homes that are out there, or probably more than 80% of them, have some form of equity. And equity is nothing but actually uh, the fair market value of the property minus whatever mortgage or outstanding borrowing balances you have, and that kind of represents the equity. So how can we use those equities in today's world and understand actually how to make most out of those monies? There are hundreds of uses. I'm going to go over some of the examples just for you to get an idea so you can relate to your personal situation. But before we do that, I wanted to actually help you understand the rates behind this. So home equity line of credits are never the fixed rate. They're consistently changing. It's and please don't get me wrong, it's not changing every day, but they're based on the Fed funds rate, which is kind of a prime rate. So Fed funds rate, as you can see in this chart, have been changing, and this is actually a long kind of a timeline since 1952 to 2018. I didn't have a chart for further since then, but the rates have been rising since then. So what happens, if you can see, at one point in a time in late 70s, early 80s, those rates were kind of 18% and little more than that. So if you were the borrower of a home equity line of credit in those days, then probably your rates were somewhere close to the 18%. But in today's market, just to compare that, Fed funds rate are currently 3.5%. So most people pay little bit above that prime rate. That's actually bank's margin for lending this money, where they are able to make money. Um, now, some banks, like where I work at PNC Bank, where I've been employee of 22 years, we also have a program where actually we do prime minus, and currently the best rate is as low as prime minus 76 basis point, which kind of like, some of the borrowers, they enjoy somewhere close to like, under 3% of a variable rate. Now, so that, just to give you an idea, like, how the borrowing works and what kind of a rate to anticipate. But remember one thing: when you are borrowing at the variable rate, as the government policies changes, so does the bank's prime rate changes, and so does, of course, your home equity line of credit borrowing rate too. So be careful in borrowing large sum of money and basically thank you, Chris. The next slide is about that. So how these rates are calculated? Well, most of the financial institutions do base everything is based on a prime rate. So for well-qualified borrower, excellent FICO score. Now there are different debates about what is called excellent, but in my views, where I work, actually, any customers that I deal with have a FICO score greater than 750. They actually are able to enjoy one of the best rates that we have to offer. Low debt-to-income ratio, again below 40%. So basically, what it's saying is no more than 40% of your monthly income should go towards the debt payment. Now, there are few changes in the calculation of the debt payment. So if you are, well, not if you are, but when you are a homeowner, you're also paying your property insurance and the property taxes. Previously, pre 2017, they weren't counting those, but now they do count actually property insurance and property taxes as a part of the debt payment. And a loan to value is less than 70%. That means, let's say if the property value of your fair market value of your property is $300,000. So as long as the total exposure is less than 70%, which is $210,000 or less, then in that case, you are able to enjoy the best possible rates. Now, one additional thing that's not listed here in a bullet point, which is actually the position. So if the bank who is giving you line of credit is in a first lien position, again, the rates are very favorable to you. But if they are in a second lien position, then the rates will be little higher because of subordination of the exposure. So what let's say if you are not in a one of the prime position that you are able to kind of borrow money that the best case possible, in those cases I would highly encourage you to work with your banker or a financial planner who can assist you actually to lock in. So many banks do offer locking in those variable rates. So let's play an example. If you have a line of credit of $50,000, and out of this $50,000 you are doing a project and you're needing about $20,000 now, and could be any of those listed projects, but we're going to go in detail in a moment. So those $20,000 would be in a more likely way, it's going to be on a variable rate. And if you don't want your payment fluctuating, then work with your banker or financial planner to assist you. And they're going to give you some ideas how to fix it. Most of the banks do offer those kind of solutions. But let's dive into that. So the primary use that I see for most of my like home equity applicants or line of credit applicants is for home improvement. So what happens is, if you have a remodeling of a kitchen to done, or maybe something to do in a bathroom. Now many times as people get older, their physical mobility also challenges, and there are times that I have seen that people have constructed their shower and the other bathrooms on the first floor instead of the second floor because of they're not able to mobilize up and down. So that would be one of the just a few example. But home improvement, if you are a younger family and if you are looking to build a fence around, or if you're looking to build a swimming pool in the backyard, or maybe a kids playground in the backyard, these are some of the uses. Now you will see some asterisks right next to some certain bullet points, and we're gonna go to this. This actually represents some tax calculation, and I'm gonna go towards the end and I explain you what does that mean. If you are actually let's say many of us sometimes become a victim of actually the credit card high interest debt. And when I say victim, is of course not, it's mostly our choice, but what happens is we are in a rising rate environment, and of course when you borrowed or when you use that card, the rates were probably low, and now the rates are rising. So certainly you have a more portion of your earned income going towards the payment. So in that case, the line of credits are much better of a use. And I can tell you, probably line of credit interest payment would be a 1/4 of what you would pay in your credit card. So basically you will be paying off your debt 4 times sooner than what you would continue paying on your credit card. Short-term financing for tuition or other education costs. I don't know. I mean, again, I don't know anything about your personal financial situation. I have two children, my two daughters, and I can tell you one thing: when kids are in a college, I mean, as much you can plan everything, they just don't do anything for planning because that's not they're good at, and they haven't had that life experience yet. So my older daughter, when she was in college, day before the payment date, now she comes to me and says, "Hey, Dad, I have a payment to do tomorrow." So uh, I mean, fortunately, I had my line of credit, so I was able to kind of tap into that and make a payment. So that would be one of the better solution. And now, again, tax deductibility of the tuition payment through the line of credit is gone, so you cannot use it. There is no asterisk, but certainly, I just want you to keep in mind. However, your CPA or the tax advisor, whoever does your taxes, are the right people to ask this question. Um, let's say if you are actually trying to buy another property in a maybe a shore area where you wanted to have a vacation home, or maybe even investment property where you are trying to get a rental income from that. So down payment, so Kristen kind of will go over, like, how to borrow large sum of money for those part of the borrowing. But if you are looking for a down payment, your home equity line of credit could be also one of the better choices. And I think that's where you're going to be able to borrow small part of the money, which is probably on a variable, which can be fixed rate. But these are the different options. Kristen, may I have a next slide, please? Okay, now paying medical bills and a long-term care expense, be careful about that. I mean, work with the insurance provider. I mean, that will be the probably better way to figure out the medical bills. But if you do have a large sum of bills and you really need to pay, then I think a home equity line of credit could be one of the better choice too. Long-term care expenses, that's something usually majority of the residents face as we grow older. Physical limitations again will kick in, and what happens is the loved ones that we have, probably they are much tied up in their personal and professional life. So we need some kind of a supervision time to time, just to do daily activities. And in that case, long-term care facilities are very good programs. So this line of credit could be one of the also alternative for long-term care expenses. uh, any emergencies, if you don't know what happens next, you don't have a savings account set up where actually you have a cushion for at least 6 months of a non-discretionary expense saved. And non-discretionary is something that you don't have a choice, but you have to pay. So I would highly encourage you, all of you, to kind of create a worksheet where you are listing all your monthly expenses on a piece of paper, multiply by 6, and that's the amount of the saving you should keep in your savings account. And if you don't have that yet, so the line of credit could be a temporary replacement. It's not a permanent solution. If you are thinking about new business accounts or new business venture where you have some idea and you don't have the funding, because newer ideas, it's not easy to get those kind of a funding, but certainly you have to self fund that. Even many times small business administration may not entertain your idea, so until the business is grounds up. So in those cases, line of credit could be a better solution. And paying off student loans, again, I would be very careful just doing that. Why? So if the student loan is actually own um, your own kind of a debt, then it may be advisable. But if this student loan is a debt for your family member, just work with your attorney, accountant, or tax attorney who is helping you to see what tax consequences you have. So that's the reason I put asterisks around a few of the bullet points, because I think it's important for all of us to connect with the financial planner or an attorney, because it's really their area of expertise. They know the current tax situation you already have. Uh, so I mean, that kind of covers my part of the presentation. Kristen, this is where your presentation starts, right?
Yes.
Okay, perfect. And I'll monitor the chat room if, in case if anybody has any follow-up question from my conversation.
All right. Thank you, Ashesh. Very similarly to HELOCs, cash out refinances are really going to have the same types of uses. I see very similar reasons for people to complete a cash out refinance. We kind of went over this last week, but the cash out refi is going to be different in a HELOC in that it is a one-time close, a one-time lump sum, whereas opposed to a HELOC, sometimes you can take multiple draws off of it. This is going to be a first lien mortgage. And there are just a little bit of differences between that. There is going to be a fixed interest rate, a fixed payment in most cases on this as well. But again, the uses are pretty much the same. I see a lot of people complete a refinance with me because they need to consolidate other debts like credit cards and unsecured loans. Credit cards carry very high interest rates, and compared to mortgage interest rates, they are extremely high, and if you have maxed out credit cards and you can't get ahead of them, a cash out refinance is really one of the best ways to consolidate your debts down to one monthly payment and save money on a monthly basis. I often see people do a cash out refinance for home improvements as well. So redoing the kitchen, the bathroom, like Ashesh mentioned, they need a new roof, different things like that is a great reason to leverage that equity in your home if you don't have the savings for it. Other investments, lately I've seen a lot of people leverage the equity in their home to purchase other properties, whether they be rental properties or vacation homes. Some people like to start a retirement account with the equity in their property. But again, like Ashesh mentioned, every financial situation is very unique to you. It's very personal. And so before you use the equity in your home, it is best to consult your financial planner and the professionals that are on your team that know details about your situation before you do this. So they can help you guide you through that and what's going to be the best use of this. The first thing that I'm going to talk about is the debt refinance. I did give one example of this last week, but I have a new example that I've been working on this week, and I think it's even a little bit better. So I had a client come to me and she needed $60,000 out to complete a kitchen remodel. The rest of the house was finished, but they needed that kitchen done yet. So it was from like the 70s. They really wanted to complete this. They were excited about it. They were also in a 30-year loan right now, and she did want to pay that off in 15 years. She has plans to retire eventually, and she wants that property to be mortgage free. So they were going to shave several years off of their loan and complete the kitchen remodel. They were totally prepared for their mortgage payment to go up significantly. When you do reduce the term, obviously your mortgage payment goes up. And when you take the money out, your payment also generally goes up. So they were prepared for that. They qualified for it. They have 27 years left on their 30-year mortgage currently. And we were able to find something a little bit better than what they thought they were going to get. So these are their current monthly debts. So they had a first mortgage and they had already taken out a home equity line of credit, I think, to do one of the bathrooms. So they were paying about $1,772 a month in just their housing debts alone. But when I pulled their credit, I found that they had 15 other debts on there. Most of them were credit cards and unsecured loans. So literally 15 other debts. Most of these cards are maxed out. It's really hurting their credit score. And on a monthly basis, they're spending almost $3,000 a month on these credit cards and their mortgages. So I have them all kind of listed out here, the balances, and then the total monthly payments of $2,859 is their monthly output. And that's not even including, insurance, groceries, gas, different things that you need to factor in monthly. These are purely the debts that show up on their credit report. So they were kind of drowning in these credit cards, sort of in a vicious cycle where they're always making the minimum monthly payment. They're never getting ahead on them. A lot of these credit cards have interest rate in the 20% range. So really not a great financial picture here, as you can see. I mean, 15 credit cards is really a lot. So Well, they didn't ask me at all about these credit cards. They had no plans of paying them off or doing anything about it. They just wanted to get the kitchen done. They wanted to have the mortgage paid off. And like I said, they were totally prepared for their monthly payment to go up. We were actually able to consolidate all of these debts in there using the equity in their home. They had plenty of equity there. So we rolled all of these debts into one. So now instead of having 17 different bills that they're paying on a monthly basis, they have one. They got the $60,000 to remodel their kitchen, and now they have zero credit card debt. They shaved 12 years off of their loan. So 12 years of principal and interest payments for them equaled almost $400,000. And they're actually saving $475 a month. So their net savings after paying all this off and consolidate everything and getting the $60,000 out for their kitchen saves them almost $500 a month. So that $500 a month should help them not open up any other credit card debts. They should have a little bit more cash there and they can start fresh. And also, as we kind of mentioned last time, depending on your situation, some of that may be able to write off on your taxes. Again, need to talk to a CPA and your financial planner before completing something like this. But there are many other advantages that I don't list here to consolidating some of these things. So that's probably one of the main things that I do with a cash out refinance. The second thing that I'm going to talk about today is going to be investing in real estate. I am not a certified financial planner, so I'm not going to talk about those types of investments. As a mortgage broker, I deal mostly in real estate, and that is my expertise. So I have a ton of people right now wanting to use that equity in their home to purchase investment properties. They're doing this for obviously to make money. Now there's a few different ways you can do this. Not many people are doing fix and flips right now, but that is a good way to do it too. You can take the money out of your home, purchase a property, renovate it, make it look new, and sell it again. And that's the shortest term type of real estate investing that you can do. But what I really am working with are investors that want to sit on these properties long-term and rent them out. So they're doing this because they can make money on a monthly basis, but also the home is going to appreciate over time. So in many years down the road, when they go to sell it, they're going to make a profit on this property as well. There are really two types of rentals when you buy an investment property. You have your long-term rentals, you know, your 6 month to a year to 2 year leases. I see sometimes even. These are very nice for the landlord. It's a little bit easier. You're not always flipping tenants. You have year-long lease agreements on average. So there's a little bit less risk for them. So for the long-term rentals. I live in Florida, as I mentioned, so we see a lot of short-term vacation rentals, Airbnb, VRBO, that type of thing. Now on this, you can make a lot more money. So that's one of the benefits of a vacation rental, but you do have more turnover, which is a little bit more work if you want to manage it yourself. But you have that opportunity for more income. You do have a little bit more risk that it's not going to be rented 100% of the time. But there's a property in my neighborhood, very close to me. They were renting it out for about $2,300 a month, and that was on a long-term rental. They had a year lease in there, and they decided, you know, we're going to try the Airbnb thing. And now they are making $6,000 a month on this property, and it is booked 3 months in advance. So again, being in Florida has its advantages. I don't know that it would be like that everywhere in the country, but they are making almost 3 times as much as they were on the vacation rental as opposed to the long term. Really, the 2 types of financing that I'm seeing for investment properties are going to be your conventional loans and then the DSCR loan. So conventional loans, most of you have probably heard of. You can do that to buy a primary residence, a second home, or an investment property. You do need to have a pretty solid credit score for this in general. I mean, I can do them down to 620, but the higher the credit score, the better on conventional loans. If you are using a conventional loan for an investment property, most people think you need a 20% down, but you actually need 15% is the bare minimum for investment properties on conventional. The benefits of getting this type of loan really are going to be they have the best interest rates and the lowest down payment available. There are some drawbacks, though. You do have to qualify from not just a credit standpoint, but from an income standpoint. So your monthly income needs to be, your debts need to be a certain percentage of your monthly income. So you are going to have to provide W-2s, pay stubs, tax returns in some cases, and everything like that. So it is a full documentation type of loan. Fannie and Freddie will only back 10 mortgages for any individual borrower. So if you're looking for, something more than that, you're going to have to go to a different program. But this is really a great fit for someone that's buying their first investment property, first or second, somewhere in there. Usually they're going to go for a conventional loan if they can qualify for it. One more drawback of conventional loans is that they do require reserves. Reserves are additional funds in the bank after you pay the down payment and closing costs. Generally, you're going to need 6 months of mortgage payments saved in the bank after those things are paid for. Right now, the DSCR loan is very popular for investors. DSCR stands for debt service coverage ratio. There are no income documentation, no income required for this property. So it's all based off the cash flow of the home. So what we do is we're going to order an appraisal on that property. The appraiser will tell us what the market rent will be for that home. And as long as the market rent will cover that mortgage payment, the loan is approved. So no income there, solely based off of cash flow. The drawbacks to this one really are going to be that you need at least 20% down, in some cases 25%. If that rent doesn't quite cover that mortgage payment, you do have to put 25% down. But this is going to be for as many investment properties as you want. So we see this really with more advanced investors, people that own multiple properties that don't want to go through all the paperwork of a conventional loan. And you can finance up to 20 units for that. So conventional loans would only be, duplex, triplex, a 4-unit property, but you can really do up to 20 units on the DSCR investment program. I'm going to go over an example of an investor that I work with. She owns one of her rental properties right now is valued around $400,000. She does have a current loan on it for $215,000, but she did have some equity there that she wanted to leverage to purchase additional properties. So we did a cash out refinance for her. We did increase her loan amount to $320,000 instead of that $215,000. But with the equity there, she was able to put down 20% on 2 other properties. So she bought 2 more properties off of the refinance from the current property, and she used the DSCR loan for both of this, or for all of these, excuse me. So for the second property, she did finance about $187,000, and then she bought it for $250,000. And then the next one she did purchase for $208,000, and she financed $156,000 of it. So this here you can compare side by side. Her current loan that she was in, she was paying about $1,866 a month for. We did refinance it. She took a little bit more out. So her mortgage payment on the first property did go up about $400 a month. But when she purchased the 2 other investments, you can see that on the first property, her monthly mortgage payment was $1,414 a month, but she was collecting $2,500 a month in rent. So she was making $1,085 a month off of the first investment property that she purchased. The second one that she purchased for $208,000, her monthly payment is under $1,200. She's collecting $1,800 a month on it. So she's getting $1,634 a month off of that property. So while her first payment did go up $400, she's now making about $1,700 a month off of that. So those are her monthly gains. That's her short-term benefits. But in 15 years, if she were to sell these properties, you're going to be able to see the benefits here. So if she did nothing, she just kept the first property and she sold that in 15 years, she'd probably make about $861,000 off of it. Now, in all of these examples, we are using the historical average of 6% appreciation per year. In the Tampa Bay area last year, homes appreciated at 20%. And I saw a statistic today that the national average last year, the average homeowner gained about $55,000 in equity per year. So I think I'm being pretty conservative when I use the 6% historical average of appreciation. but this is going to give you a really good idea. So on that home, she did lose a little bit of the equity there because she did the refinance. She took a little bit more out. So instead of making 861,000 on that in 15 years, she is going to make just under $745,000. But then she also has the second property that she can sell for under $500,000. And then the third property at $390,000. So this is the net worth. This would be after she sells the property and pays off the mortgages. So this is all her, excuse me, this is all her equity in the property, in the homes. So you can see she's making well over $1 million based off of that $320,000 refinance that she did. So investing in real estate is, again, not for everybody, but this is a great way to leverage the equity that you have in your home. So that's it for me. Here's our contact info. And if anyone has any questions, please go ahead and put those in the chat right now. And if not, you can always email us or give us a call after this as well.
Awesome. Let's see. Doesn't look like we have anything in the chat. All right.
And Tracy and Kristen, while we are still waiting for our participant to respond, just in case if you have any question, just one additional point I wanted to make. Many times I have a question that I come across. People ask me as a financial planner, is it a wise idea to take out the equity from the home and use that as a capital towards your capital investment in a stock market? Again, the answer is probably is not one size fits all. You have to work with your financial planner, your tax attorney, any advisor that you have. Please work with them, because it might work for someone, but it's not going to work for everybody. And that's where we are able to kind of have a one-on-one conversation just to coach our participant if they have any additional question of similar type or something different. There is a question in there from Wendy. Thank you, Wendy. Can client use HELOC or cash out when talking about separation or divorce? Wendy, I can kind of answer most of the HELOC questions. Yes, actually, you are able to use equity, but remember that certain different states have also their own guidelines when it comes to borrowing money as a married person or a separated spouses. Some of the states do require the spouse's consent on the borrowing paperwork. So that would be something you have to be careful before you put an application. Make sure you work with your local bank and find out exactly what are the requirement for your individual state before you plan for those kind of cash out.
Awesome. So I have a question. I'm not, and I'm sure we probably touched on this, but if you would have an outstanding, if you have your regular mortgage and you have a HELOC, what is the process if you want to roll those together? In other words, you want to pay off, or I'm sorry, not a home equity line of credit. What would the process be if you want to merge those into one? Is that refinancing? How does that work?
Yes, so it is actually the same thing, actually, what Kristen was saying. So let's use an example. Let's say if somebody has a property value of $400,000, they have a mortgage of $250,000 and $50,000 in a home equity line of credit. So currently outstanding balances are about $300,000. Now, yes, sometimes it's a good idea to refinance and put them in a one, but again, situation could be different for different people. So it depends on what your outstanding rate now. So if the rate you are paying is better than what you will be getting, then I wouldn't recommend you going for that refinance, because you are better off what you have. and also long-term objective too. So what is if the purpose of that refinancing is just a savings purpose, then probably may not work. But if the purpose of refinancing is actually lifestyle changes, or maybe income have dropped and you really wanted to extend that again from 22 year left on a mortgage or home equity to now again 30 years, so you have easier time on your paying monthly payments, in that case that may be working. So again, each situation is different, Tracy, but that's a great question because I'm sure many of our listeners can relate to themselves.
I know quite a bit of people that had taken advantage of that when their housing values went up, and now are facing two payments. So that's good to know.
And Kristen, if you have any additional thoughts, please help us.
Yeah, I think, when people want to combine them, it does depend on what phase of the HELOC they are in. If they're in repayment, if the rates are adjusting and the payment goes up, then that's a good time to consolidate them.
All right. Well, thank you so much for your time. We really appreciate you here. Again, Kristen and Ashesh are a part of our amazing volunteers on our helpline. So if you have any questions that you would like to ask regarding finances, please come to our helpline. We're here to help you. So thank you for joining us. And if you have any